welcome to the last investment update of the year. I'm here with Ayrton Oliver, our portfolio manager, and I'm Stephanie Whittaker, one of the advisors here at Generate. Welcome, Ayrton.
Good morning.
So, Trump won. What does this US election outcome mean for markets?
Yeah, so Trump won with a more of a landslide than expected. So he was expected to probably win, but not get a sweep across the Senate and Congress and the House. So he got all three, which means he's going to be able to put in a lot more of his policies. So on the face of it, it looks like those policies will be stimulatory to the US economy. He's going to have tax cuts and probably pro-growth, pro-US growth, especially domestically. So that's seen US markets kind of rocket higher at all-time highs. Especially benefited the small and medium cap companies, which are more domestically focused in the US. On the other side of that, though, we are also seeing worries of inflation coming through. So if he does put tariffs in on China and the rest of the globe, that will push costs up for US imports and also put costs up if they have to make things onshore, which were previously cheaper to make offshore. So with that inflationary impulse coming through, you're seeing interest rates in the US spike higher with the idea that the Fed might not be able to cut as much. And also the long-term interest rates are moving higher with the prospect of a lot more spending. There's potential that he has $7.5 trillion worth of tax cuts planned. If he cannot pay for those by cutting costs somewhere else, that's borrowing and that pushes up interest rates from the bond curve. And lastly, the US dollar is getting a good boost on the back of potential stronger US growth, but also maybe inflation.
So what do you expect this means for the rest of the world and New Zealand?
Yeah, so for the rest of the world, it's still a bit unclear. We're still waiting to see what he actually goes through with. But from what we know already, it could be negative for China and Europe because he's going to put tariffs in. Those tariffs will mean that it costs US people more to import from China or Europe, so they'll either stop buying it because it costs too much, or they will just kind of substitute to local or domestically made goods in the US. So that will be negative for European growth and also be negative for Chinese exports. If they cannot find someone else to buy those exports, like us, that will be negative to Chinese growth as well, which is likely some kind of, probably in the middle, you have a slower growth, but also they will try and push their exports onto someone else like us. So that means that we'll see cheaper goods flooding the rest of the world and also China slowing down, which means they will probably slow down on their imports from us and people like Australia. So probably not good for Asia and European growth. And on the other side, you've also got the geopolitical probably volatility that will come in. So he is kind of unclear what he's going to do, but he's trying to push back on all the spending that's going outside of the US, especially defence spending, which could impact Ukraine and Russia and the Middle East. And depending how that, how that kind of materialises and what he does to actually on the other side, trying to slow down some of these wars without just pulling back spending, that could cause some volatility in those markets.
Right. So while we're talking about New Zealand, the RBNZ, they've begun cutting and mortgage rates are going lower. What's your outlook for New Zealand?
Yeah, so we've cut 75 basis points already, so it's on the right track. They meet later this month, and it's likely we're going to cut another 50. So the New Zealand economy is clearly slowing. I think if you talk to anyone around town, things are getting tough out there. The unemployment market, or the unemployment rate, has ticked up. Employment market is obviously tougher now. People are finding it hard to get jobs. You're hearing more and more about redundancies and people getting the hours cut back. So that's a consequence that was expected as the RBNZ hiked rates. Inflation's starting to play ball, so it's down at 2.2%, which is in the middle of their 1 to 3% band. So that's good. It means the RBNZ can keep removing that tight monetary policy we had. So it's likely we're going to cut another 50 basis points this year, and then probably another 100 basis points down to the mid-threes by the end of next year, which is what the market's already expecting. This could change with the global outlook, but I think, if anything, it could go lower if inflation really falls through because of Chinese deflation getting pushed globally.
How have we been reacting to these moves and how are the portfolios positioned?
We've been pretty active and pretty dynamic and agile, I guess you'd say, which is a good thing for our members, and it's what we've been able to do as an active manager. We've been increasing our allocation to growth assets, which is the stock market basically, especially the US stock market over the last couple of weeks, and this has worked really well with the stock market at all-time highs post-Trump getting in. We've since then added a bit more to try and jump on this momentum that we're seeing in the markets. That's keeping going higher as people really price in the stronger US outlook locally in the US. And that's been, been very, very beneficial, and we'll keep monitoring that and see how we go and look for reasons to take it off. On the fixed income side, we've been very close to benchmark where we wait for higher yields to reinvest. The yields had got to a point where they're quite low, so now happy to wait, and it's going our way where interest rates are moving higher across the globe. That's dragging New Zealand rates higher as well. So we'll wait for higher yields to reinvest and put more interest rate risk on. And lastly, the US dollar has had a very good run. So with the higher expected inflation in the US and higher rates in the US, that's pushing the US dollar up. Means New Zealand dollar is going down, which is good for our US dollar holdings. So we've benefited, the funds have benefit from the US dollar strength. And yeah, for now, we will continue to monitor that.
So what are the key events to watch out for from here?
So we've got the Fed this morning. So that is expected for them to have a 25 basis point cut. It's basically 100% price, so there's nothing really to see here. It'd be quite boring. And for the rest of the year, they are likely to be monitoring the new government, and so anything that was kind of thought of before, it doesn't really matter. We kind of try and work out what he does and if he causes inflation in the US or not. We have New Zealand RBNZ, so we got that at the end of the month. It's pretty much fully priced for a 50 basis point cut. Anything that changes between now and then would be likely on the employment front or global front, which may mean we can cut more. At the moment, it doesn't seem likely. We've also got the US inflation next week. So now it kind of feels a bit of an old data point because we've got a new government in which could change everything, but it'd be good to see that US inflation is coming back down.
Yeah.
And lastly, we've obviously got the election outcome, so that will still follow through, and I'm sure we'll see some tweets from Trump or something like that, and we'll find out whether or not he's actually going to put these tariffs in place, and also if he goes ahead with all his tax cuts, which is good for the US economy, but how is he going to pay for those?
Watching with interest. Thanks, Ayrton. Thanks for watching.